joined by Tanvee Gupta Jain, Chief India Economist at UBS. Tanvee, thank you so very much once again for taking time out for us.
Thank you. Always happy to be in the show.
Yeah, always happy to have you for this. So, I'll dive straight into it. First off, do you expect this to be yet another policy with absolutely no change on the benchmark lending rate or stance? What are you looking out for?
Absolutely. So I think this policy, even if I look at what is happening on the macro front, we are seeing signs of softening. We have already seen leverage-led growth is also kind of fading down. Inflation, at least for the month of September, and the data which you will get on, next week post the monetary policy will show an uptick. So largely, if I look at rates as well as on the stance, we are expecting status quo. We are not expecting RBI at this point to change the policy stance, which is right now withdrawal of accommodation. This policy will be a very interesting one. As you rightly mentioned, there are 3 new external MPC members joining. If you remember, in the last 3 external MPC members, 2 were quite dovish and were voting for a rate cut. So it is very interesting to see how the new external MPC members, because the starting slate is going to be more towards neutral, is definitely going to set the space on how the monetary policy forward is going to shape up. The second interesting thing is, if you look at RBI's growth forecast, they're at 7.2%. For FY25, we are at 6.8%. Even in the economic survey, we have seen that the government was even mentioning that the growth could be closer to 6.5–7%. So clearly, RBI is slightly optimistic on the growth front. And when I track UBS India Composite Economic Indicator, which is a compilation of 15 high-frequency data for India, it is clearly showing me that the momentum has started to soften, specifically from August onwards. So, for example, June quarter, we were all expecting that the growth would have slowed because parliamentary elections happened. Plus, there were heat wave conditions in April, May, and the growth would begin to normalize from September. But at least whatever leading indicators that we are tracking is not really showing any big uptick in the growth momentum, even in the September quarter till date. And I think the bigger worry...
No, please continue.
I think the bigger worry which I have right now is that the government spending on capex is also showing a downtrend. I would say from an RBI perspective, it is a very interesting policy because the inflation number which will come up for September will be showing an uptick. The growth might be surprising on the downside. And plus, I think they would like to, stay on the cautious side because they would like to see, we have already started seeing withdrawing monsoons, but you would want to see how the food inflation will pan out. So I think from a monetary policy perspective, very much status quo, but definitely a bit of caution, both on the growth, on the downside risk, as well as on inflation. At least we are 30 basis points below RBI's focus, but how is RBI looking at inflation going forward?
Okay, got it. So, actually, I do have follow-up questions on both some of the points you raised regarding growth as well as inflation. And I'll start with growth first. Like you said, we are seeing some easing in momentum. That's evident in high-frequency indicators as well, several of those. What are the reasons behind it? One, like you said, was possibly the heat waves and then eventually the impact of the monsoons. Is rural spending not picking up to the extent that one was expecting? Also, what's the outlook? So for the ongoing quarter as well as for the next quarter, can we expect some sequential pickup next quarter then?
Okay.
For the ongoing quarter, actually, for the October-December quarter.
So if you look at the data, if you look at how the Indian economy was shaping up, we were in a kind of a Goldilocks scenario since FY22. The growth was actually doing very well. The macro risks were very, very manageable. But since FY25 onwards, especially the June quarter was a little slowdown, but that was largely expected. The general expectation was September quarter we should see an uptick, but bulk of the data points or high-frequency data points are actually not showing an uptick. They're showing a softening trend. December quarter, which is the ongoing quarter, generally because there is a festive season demand, and this time we are seeing that Diwali is mostly, on 1st of November, so automatically the festive season is a bit delayed. and the consumer spending generally tends to pick up during the festive season. The expectation is that the December quarter could be better off than what we saw in the September quarter. But yes, whatever data which we are seeing so far is showing that the growth, which was quite subdued in the June quarter, that trend would have continued in the September quarter as well. When I was looking at my quarter on quarter increment or sequential increase in my composite economic indicator, it was up 1% in the March 2024 quarter. It was up 0.6% in the June quarter. And for the September quarter till date, it is actually quite flat at 0.6% so far. So I would say I'm not really seeing an uptick. I would say the trend is definitely towards the softening momentum. When I look at consumption, capex, and exports, what I realize is that till last year or till the affluent Indian consumption was holding up pretty well, but it looks like now it is showing signs of a fatigue. Income levels are normalizing, household debt service obligations are going up, and in fact, my estimates are showing that household savings have seen a marginal pickup, so they are no longer dis-saving to fund their consumption. When I look at the capex cycle, and we do realize that the heavy lifting was done by the government because the private corporate capex recovery is yet to turn up significantly. I was very surprised to look at the data on central government spending that it is still YTD. There is a double-digit decline in capex spending. We did see a pickup in the month of July, but August again there is a slowdown or a contraction in government spending. And this is not only happening at the central government; it is also happening at the state government level. So we are seeing somewhat of a broad-based slowdown in India's economic cycle.
Okay, all right. And coming to the inflation front, so like you said, we did see a tepid inflation print the past 2 months, but we do expect somewhat of an uptick in the September print, and that's what's one of the factors that's likely to keep the RBI MPC on its toes, especially with regards to food inflation. But what are your projections? Can we post-September then expect some normalization? What do high-frequency indicators in terms of the key vegetable prices suggest? Are we seeing some improvement there as well on the prices for potatoes, onions, tomatoes? Also, given the fact that the monsoons are largely behind us, but we are seeing some off-season rainfall, how much of a risk does this present to the food inflation outlook then?
Sure. So as you rightly pointed out, we are expecting that the CPI inflation for the month of September will be above 5%. What is interesting is that when I look at vegetable prices, the onion prices are expected to remain elevated till September. But normally we have seen that the tomato prices, after peaking out in July, August, sequentially they begin to fall. But so far, even in the month of September, even the tomato prices are still quite elevated. So vegetable prices are not slowing as sharply as we have seen in the previous few years. The second interesting thing is we have seen edible oil price increase by almost 19%. Edible oils have a 3.5% weight in CPI. So there is going to be a direct and indirect impact. Obviously, that hike came in only on September 13th. So the impact may not be completely shown up in the September number, but I think there will be an impact even on the second round, which will show up in the, from the December quarter onwards. So before taking into account this increase in edible oil duty, we were expecting that CPI inflation in our forecast was coming 30 basis points below the RBI's forecast of 4.5%. We need to see how much is the second round impact in terms of, FMCG companies actually taking a hit in their own margins or actually passing on that price hike to the consumers, because consumption spending has been a bit muted, especially for the mass market consumption items. But if you look at how the CPI inflation forecasts are going to pan out, I think the month of September definitely an uptick above 5, but for the remaining months, mostly my inflation numbers are actually below 5%. And the month of September increasingly is also there was an unfavorable base effect. So I think we need to even discount for the fact that there was an unfavorable base effect at work. But I would say unseasonal rains if we end up seeing in the months of October, November, there could be more upside than downside to my forecast. So as of now, we are 30 basis point below the RBI's forecast. In case you end up seeing unseasonal rains, my forecast will be quite close to where the RBI is at 4.5.
Okay, so given all of these factors that you've laid out for us, you do believe that the RBI's rate cutting cycle is set to commence from December, is that right?
Actually, yes. So I think what we also take into account is that the global monetary easing cycle has begun. We have seen that the Fed has already cut the rates by 50 basis point. My UBS economist is expecting another 50 basis point in rate cut by end of 2024. So if I look into account the global monetary easing cycle, we do expect that RBI will also start cutting the rates by 75 basis point in this cycle, starting the December policy. In fact, I'm more of the camp that the policy stance and the policy rates should be changed at one go rather than doing one change of stance, the withdrawal of accommodation in October, and then changing the or cutting the rate, say in December or the Feb policy. So I'm more of the camp that both policy stance and the rates will change at one go. We are right now pricing in a 25 basis point rate cut by the RBI in the December policy. But as RBI Governor has been highlighting, India's rate cut cycle will be a function of domestic growth inflation dynamics. So in case we do end up seeing any upside risk to inflation panning out, say the unseasonal rains come up in October, November, in that scenario, you might see the rate cut cycle getting delayed to Feb. But as of now, I think 25 basis point rate cut starting December policy is our base case.
Okay, all right. So, given you spoke about several global developments, like for instance, the US Fed already having cut rates by 50 basis points and UBS expecting another 50 basis points rate cut in the current year. I do want to ask you, a lot in the moment seems to depend on several global developments, geopolitical ones, as well as what's taking place in the US economy. One of the cases that is of a slight concern at the moment is a possible scenario where in the US elections, Donald Trump sees a win, and then what that would mean in terms of the tariff that might be imposed on China, and in turn what kind of an impact that will have on the Indian economy in terms of exports, the RBI having to manage the rupee. What are your views on all of that, and how much of a concern do you think that is at the moment?
One of the big factor what we are highlighting is the global growth uncertainty, which will also be dependent upon the upcoming US election and whether or not we see Trump coming into power and a likely trade tariff on China. And the second is what in that case happens, whether there is a risk of China's excess capacity getting offloaded in the local market. So we need to realize that one big thing which has been delaying India's growth recovery is actually the fact that we are yet to see a private corporate capex recovery. I mean, the heavy lifting was done by the government. The residential housing market started reviving, but we have yet to see a big turnaround in the private corporate capex. In case there is a potential US tariff hike, which basically increases the risk of China offloading excess capacity in the manufacturing sector, I think a corporate capex recovery in India might get further delayed. If I have an option as a corporate to buy a cheaper China import, why will I be expanding my production capacity in the home country? So I would say that could be a big downside risk. In fact, when we looked at the scenarios, we realized that if I look at across Asia, India is one of the lower beta economies. Normally, you realize that higher export to GDP economies have higher beta, whereas beta for India is actually less than 0.5. But even though India will be one of the lesser affected economies in case you do see US election uncertainty, but there will be a spillover effect because India is not immune. So yes, so that is a big concern even that we are highlighting, even from an India's corporate capex recovery and its impact on overall GDP growth.
Okay, that's an interesting perspective actually. I also want to ask you regarding what we've seen in terms of crude prices. We did see some comfort coming in with Brent crude trending below $70 a barrel, but that was for a very brief period of time. Post that, we've once again seen some flaring up of geopolitical conflicts globally, and that is causing some concern. And I know it's too early. We're still going to have to wait and watch for how that scenario plays out to determine what the repercussions will be for India and its external finances. But what's your stance at the moment on that?
Okay. So yes, we have seen a tailwind for oil prices last month, and now it is becoming a headwind. So far, oil is still trading below $80 a barrel, which is definitely a solace. Now, India is importing 87% of our oil requirement, so any increase in oil prices significantly will impact India's macro risk. Our analysis suggests that we can sustain oil up to $90 a barrel without really causing any big wider macro concern for India. So in that sense, I think we are still okay. But in case the geopolitical risk which we are seeing globally keep on flaring up, and in case there is any repercussion on higher oil prices, we might be seeing more concern, especially on the current account deficit. Now, let me show you what we were looking. When I was looking at the data, I realized that even not even last year, even so far this year, even though the discount to buy oil from Russia has come down dramatically, India is still buying a reasonable chunk of oil is getting imported from Russia, where the payment is not made in dollar terms. I think that is also one kind of silver lining, because even if oil prices go up and India is still buying oil from Russia, we are reducing the usage of our FX and bringing some solace to our currency. But yes, I would say anything above $90 a barrel oil will start widening India's macro risk. Till the time oil is well within that parameter, I think we are okay.
Okay, all right. Tanvee, I do want to ask you about a very interesting report that you put out recently. You spoke about India's K-shaped consumption pattern. That is something that was, widely discussed around the pandemic and right after that as well. Currently, how are you viewing that? And do you see some narrowing of that K-shaped consumption pattern going forward?
Okay, so this is something which we have been doing a lot of research and have been writing quite often, and we are acknowledging the fact that India was seeing a K-shaped consumption since the pandemic. And what we realized is that anything which was affluent premium segment consumption was holding up very well. But anything which was mass market, we did see that there was quite a momentum which was softening. And the hope is that this K-shaped consumption pattern could narrow in FY25. So when I look at K-shaped consumption pattern, I realize that the premium affluent segment consumption, which has been doing or holding up very well, is now clearly showing signs of a fatigue. When I look at corporate wages, especially the data on listed companies on employee expense, I realize that the growth in income levels is clearly normalizing. Second is because we did see a leverage funded consumption. And now when we look at household debt service obligations, they are going up. And the third is, we were seeing that households savings in India has actually come down from 24 to 18%. And when I was looking at the numbers, I saw a marginal uptick, maybe because a lot of households could have brought physical savings or real estate. So I would say the premium affluent consumption is clearly showing signs of peaking out. When I was looking at the low income segment consumption, and we did see a very mixed recovery through the pandemic, because this section of the society were the worst affected during the pandemic. And I realized that at the bottom end, there is definitely a support, and that support is coming either because of social welfare spending and stimulus by various state governments, especially the states which have gone for elections in the last 1 year, have been announcing a lot of populist spending, which is directed to the low income strata. We were expecting a cyclical recovery in rural demand, because if the monsoons are good, it matters for rural sentiment more than rural income levels. public capex, even though there is some disappointment because in the June quarter, the public capex numbers were showing a contraction, which was expected because of elections. I would have expected that would have reversed and shown a significant pickup in the September quarter. But so far, FITD numbers are still showing a contraction. So that is something I would expect that the government spending towards capex programs to pick up, because that construction is one of the largest generator of employment in the rural economy. So our expectation is that this K-shaped consumption pattern could kind of narrow in FY25, and let's see how it goes going forward.
Okay, all right. So, given what we've discussed today, it almost appears like, of course, while growth broadly does appear to remain resilient, even as your report highlighted, it's almost like that Goldilocks moment for the Indian economy appears to have peaked. Suddenly, we are seeing some concerns, of course, from global developments on the geopolitical front. We're seeing some easing in high-frequency indicators in India as well. A lot appears to depend on the festive season and how that pans out for several industries. Another very interesting aspect that even your report sort of put the spotlight on was what's happening in terms of state finances. We're seeing a whole host of states, that are currently seeing in the middle of elections or about to see elections, and that's had some impact in terms of the poll promises, what those could mean in the months going forward. So tell us a little bit about that, and at this point, is it more of a wait and watch mode, or are there some downside risks to state level fiscal deficit going forward?
So let me start with the state level fiscal position, because this is something which I don't see a lot of people are talking about it. So whenever we look at the India's budget, we see that India's central government is sticking to the fiscal consolidation roadmap. They are doing even better than what they have been promising. This year, fiscal deficit target was even lower than what they promised in the interim budget, at least in terms of targeting. But where I think the investors should also focus on that when you look at India's fiscal position is actually center plus state. And when I look at the state government, I can clearly see that there is a fiscal profligacy, which we have seen in poll-bound states, especially the states that have either gone for election the last 1 year or will be going for election this year. And what we realize is that most of these states have announced an increase in social welfare spending. In fact, when I look at, and a lot of these states actually even revised their fiscal deficit estimates when they first announced in Feb, and then they revised it in June and July during those months. So if I compare it with FY24, based on 24 states data, which I have collected, and look at their FY25 BE, I realize that the deficit is going to go up by 20 basis points. That is from 2.9% of GDP last year to somewhere around 3.1% of GDP this year. At some point, this is going to weigh on states' own capex spending. I mean, if there is a limited budget, and I am announcing a lot of social welfare spending, then something else needs to come down. And if you look at April to July states' capex spending, it is already down 13% year on year. And we need to realize that when I look at government capex, even if the share is 55% center and the remaining is states, so states is not really a very insignificant portion. They do contribute to a lot of capex on the ground, and where I think we are already seeing a slowdown in the capex spending because of the fiscal profligacy by various Indian states.
Okay, all right, Tanvee, with that, we're completely out of time, but thank you so much for an extremely wide-ranging and informative discussion. Always a pleasure having you on board.
Thank you so much.